Okay, so, even the really big established companies can hit, well, unexpected bumps in the road sometimes.
Absolutely.
Take PepsiCo, for instance. I mean, their brands, Pepsi, Lay's, they're everywhere, part of our lives for ages.
Total staples.
But it looks like they might be facing some surprising headwinds as we look towards 2025.
Exactly. And that's what we're diving into today. We're looking at an article from The Motley Fool that really digs into PepsiCo's revised financial outlook for next year.
Right.
It really shines a light on the kind of challenges even a giant like Pepsi can face in, the current economic climate.
So our mission here is basically to unpack why they've lowered their guidance.
Yeah, what's behind it. And then the big question for you, the listener, is the stock still a good bet? Especially since it's a Dividend King.
Ah, yes, the Dividend Kings. Just a reminder for you, that means companies with a super long track record, decades really, of increasing their dividend payouts year after year.
Exactly. So stability is usually the name of the game there?
We want to cut through the jargon, right? Get to the heart of what this tells us about, well, consumer spending, global economics, and just how resilient these big brands actually are.
Get that clear picture without getting lost in the weeds.
Okay, let's hit those headlines then. PepsiCo lowering guidance for 2025. What are the main reasons the article gives?
Well, it points to a few things that are kind of interconnected. You've got strains in the supply chain, the broader economy being a bit shaky, and importantly, shifts in how consumers are actually spending their money.
So it's not just one thing, it's a combination.
Pretty much. And this isn't just a tiny tweak to their numbers. The article stresses it signals a noticeable change in their expected growth path.
Okay, so how much of a change are we talking? Quantify it for us.
Right. The numbers mentioned are a projected 1.8% drop in revenue. And maybe more significantly, a 4% decline in what they call constant currency earnings per share.
Okay, constant currency. Let's quickly explain that for everyone. It basically means they're trying to show how the business itself is doing without the ups and downs caused by changing foreign exchange rates, right?
Exactly. Since they operate globally, currency fluctuations can make year-over-year comparisons messy. Constant currency kind of strips that away, so you see the underlying operational performance.
Makes sense. Gives you a cleaner view.
Uh-huh. And the article notes this news has, pushed Pepsi's stock price down. It hit a 52-week low, actually, and it's hovering near a 5-year low point.
Well, okay. So the market definitely reacted to this.
Big time.
And what about the view from the top? Did the CEO, Ramon Laguarta, have anything to say?
Yeah, and his tone wasn't exactly upbeat. The article quotes him from the earnings release talking about increasingly dynamic and complex geopolitical and macroeconomic conditions. Pretty serious language.
Geopolitical and macroeconomic. Okay, so global uncertainty playing a big role.
Seems like it. He also specifically mentioned expecting higher supply chain costs, likely because of, shifts in global trade patterns.
Right, that makes sense. Tariffs, shipping issues, all that stuff.
And on top of that, he pointed to consumers being more conscious in many markets, sort of a subdued and uncertain spending environment.
So, a bit of a challenging picture overall. Let's dig into the revised financial expectations for 2025 then. What are the specifics?
Okay, so first, organic revenue growth. They're now guiding for just a low single-digit increase.
And organic means growth from their existing business, yeah. Not counting new companies they buy or parts they sell off.
Correct. So that low single-digit expectation is definitely less rosy than what they might have hoped for previously.
But they're still planning shareholder returns, dividends, buybacks.
Oh, yeah. The plan is still to pay out a hefty $7.6 billion in dividends next year.
That's substantial.
And also buy back about $1 billion worth of their own stock. So capital is still flowing back to shareholders.
Okay, but where's the main shift then, if dividends and buybacks are still strong?
The key change is really in the earnings per share, or EPS, outlook, specifically the core constant currency EPS.
Right, core EPS. That excludes one-off things like restructuring costs or acquisition expenses, giving a clearer view of ongoing profitability.
Exactly. And they previously guided for mid-single-digit growth in that core constant currency EPS. Now, they're expecting it to be basically flat compared to this year.
Flat. Okay, that's quite a downgrade from mid-single-digit growth. That signals profitability isn't growing as expected.
Precisely. And if you compare this flat outlook to their original hopes, The article calculates it means their overall core EPS for 2025 is now expected to be about 3% lower than they initially thought it might be. They were initially expecting a slight increase.
Okay, so a 3% negative swing versus their earlier internal baseline, that really highlights the impact of these headwinds.
It really does, and a huge part of this seems to be driven by us, the consumers.
How so? What's changing?
The article really emphasizes this idea that for many shoppers right now, it's all about the absolute dollars. The upfront cost is king.
So even if a bigger bag of chips is cheaper per ounce, people are opting for the smaller single-serve bag because the actual price tag they see at the checkout is lower.
That seems to be the trend. Lower immediate cash outlay is the priority.
Makes sense in a tighter economy. Is PepsiCo reacting to this?
Very much so, it appears. The article mentions their strategy is shifting to offer more of those smaller single-serve options and also smaller multi-packs.
Smaller multi-packs, too. Interesting.
Yeah, it's about keeping the brand accessible, keeping that price point manageable for consumers who are watching every dollar.
They even mentioned, didn't they, lowering the price on some 10-count multi-packs, which seems counterintuitive if their own costs are rising.
It does on the surface, but it might be a psychological play. The article suggests focusing on the price per pack within that multi-pack. Even if the total cost isn't drastically lower, making each individual unit seem cheaper can boost the perception of value.
The perception game. Makes sense.
Especially for their snack business, which the article says is really leaning heavily on options priced under that $2 mark.
Wow, under $2. That really shows how price-sensitive things have become.
Definitely paints a picture of a very careful consumer right now.
But okay, despite these challenges, PepsiCo isn't just sitting back, right? The article mentions acquisitions. They're making moves.
Exactly. And these moves seem quite strategic, tying back into those consumer shifts we were just discussing. It shows they're aware and trying to adapt.
So what kind of acquisitions are we talking about?
Well, they took full ownership of Sabra and Obela, think hummus and dips. They also bought Siete Foods, which is a Mexican-American food brand often seen as a healthier option.
Okay, dips, healthier Mexican-American. What else?
And then there's their plan to acquire Poppi, that prebiotic soda brand that's been getting a lot of buzz lately.
Poppi, right. So looking at these Sabra, Siete, Poppi, it seems like a deliberate push beyond just sugary drinks and, let's say, traditional snacks.
That's the interpretation, yeah. It looks like a clear effort to tap into that health-conscious consumer trend, maybe even offer things that work as quick meal replacements or components.
Diversification into potentially faster-growing, healthier categories. But are these acquisitions, big enough to really make a difference for a giant like PepsiCo soon?
That's the million-dollar question, or maybe $1 billion in their case. The article is pretty clear that, for now, these deals are too small to significantly impact the overall bottom line in the short term.
So more like planting seeds for future growth.
Seems that way, laying groundwork for the long haul in different market segments.
Okay. It wasn't all doom and gloom in the article, though, was it? Were there any bright spots in their core business?
Yes, definitely. It highlighted that the main Pepsi brand has actually been gaining market share.
Oh, really? How?
A lot of that seems driven by their focus on zero sugar options, which are really connecting with consumers.
The zero sugar trend continues.
It does. And also Gatorade and Propel are still leaders in the sports drink category. So some core areas remain quite strong.
Good to know. And what about efficiency? Are they trying to tighten their belts internally?
Yes, that's another key part of their plan mentioned. They're focusing on optimizing their entire value chain.
Value chain, meaning?
Basically everything from making the products to distributing them to the sales process. They're looking for efficiencies everywhere to help boost their profit margins over the long term.
Okay, streamlining operations. Standard playbook when facing pressure, but important.
Absolutely. Every little bit helps when growth slows.
All right, so we've got the challenges, the consumer shifts, the strategic responses. Now let's pivot to the investment angle. The article seemed to suggest the stock might actually be a good buy now because of all this.
Yeah, that's the interesting twist. The argument is that because expectations have been lowered so much, the valuation has become pretty attractive.
How so? Walk us through the numbers again.
Okay, remember, that projected 3% decline in core EPS for 2025. Based on that, the article estimates PepsiCo's core EPS next year could be around $7.92.
Right, $7.92 per share in earnings.
So if you take the current stock price and divide it by that $7.92 earnings forecast, you get a price to earnings or PE ratio of about 16.8.
16.8. And is that considered low?
For a stable, high-quality company like PepsiCo, especially a Dividend King, yeah, that's quite low. The author literally calls it dirt cheap.
Dirt cheap, huh? Strong words. So the idea is you're not paying a high price for each dollar of expected earnings.
Exactly. And crucially, the article reassures that the dividend looks safe. Even with slower growth, the company is still very profitable.
That's key for income investors, isn't it, if you're counting on the dividend check?
Absolutely. That history and reliability is a big draw. The article does flag the increased debt from those acquisitions as something to watch.
Right, you mentioned the debt earlier. Is it a major concern?
Not immediately, it seems. They say the leverage ratios are currently in decent shape, but it's definitely something you'd want to monitor going forward, that net debt level.
Okay, so keep an eye on the debt, but the valuation looks appealing and the dividend seems secure. So what's the article's final verdict on the stock?
The conclusion is pretty clear. PepsiCo is presented as a high-conviction buy for value investors.
Value investors, people looking for stocks that seem priced below their intrinsic worth.
Correct. Specifically those with a longer-term view, say 3 to 5 years out, and who are mainly interested in generating passive income from the dividends.
And the logic is, with expectations now so low, maybe it's easier for PepsiCo to surprise on the upside.
That's part of it. There's potentially more room for positive surprises than negative ones now. And while you wait to see if that happens, you collect that dividend.
Which is yielding what right now?
Around 4.1%, according to the article, which is quite attractive in today's market for a stable company.
4.1% yield while you wait. Okay, that's a solid incentive.
Definitely helps patience.
All right, let's wrap this up. Just to summarize the key takeaways for you listening, PepsiCo is definitely navigating some choppy waters, supply chain issues, economic uncertainty, changing consumer habits, leading to that lower 2025 forecast.
But importantly, they aren't standing still. They're adapting, acquiring brands in faster-growing, healthier spaces, focusing on value for consumers, and trying to become more efficient.
And because of these challenges, the stock's valuation has come down significantly, potentially making it an attractive entry point for long-term value and income investors, especially with that solid dividend.
Precisely. Hopefully, this deep dive gave you not just the specifics on PepsiCo, but also some broader insights into, the economic currents and consumer trends affecting even the biggest players out there.
Absolutely. It's a window into the bigger picture.
Yeah.
And just to leave you with something to chew on, thinking about PepsiCo trying to diversify and adapt, what other huge established consumer companies might be feeling similar pressures right now, or maybe finding similar opportunities? And what can we learn by watching how they navigate this shifting landscape? Definitely something to keep an eye on.